Hello, this is Brian Shannon from Alpha Trends Blogspot. Today is Wednesday, the 21st of March, 2007. On Wallstrip today, what we're going to do is take a look at some of the stocks that I think are best set up technically, that is on the long and short side. Maybe not necessarily short, but I think stocks that you definitely want to avoid or be very careful with. First, we'll look at shares of VCA Antec, symbol WOOF. This stock is still in a great uptrend. We've got that rising 50-day moving average here. And if we look at a weekly time frame, you can see that this recent breakout that has pulled back has now brought the stock back to last year's resistance, last year's highs. So this resistance near the $36 level looks like it's acting as support in here. We've also got that rising 50-day moving average that was just recently touched, or close to being touched. That's the green one right here. But it is in a uptrend, so innocent till proven guilty with a rising 50-day moving average. And on the weekly time frame, you can see the consolidation has occurred with very little volume. So it doesn't look like there's a lot of selling pressure in this area, and it might make for good new purchases. I think before I would purchase it, though, I'd want to see the highs from the last couple days, maybe in the last week or so, taken out. I think above $37 really puts the buyers firmly in control. It kind of looked like it was going to break out here a couple days ago, past this level at $36.50, but then it kind of failed. So now I'd like to see at least take this high out. Even more bullish would be a move past $37 a share. You could probably, if you were to purchase it up there, I think a stop probably ought to go under this $36 level or so. But the stock looks like it's still in a very nice uptrend and could continue to hit new highs here. CMG, Chipotle, Mexican Grill. This stock on the weekly time frame is, it tried to break out here about a couple weeks ago, about a month ago, past that $65 level. But it keeps coming up to that level, and it looks like, actually, if you look at it this way, you can see that here we can see a shoulder, a head, a shoulder. It broke past the neckline here, so we could come up with a target, just eyeballing this, about $47 a share, up to the top of the neckline at about 62. So that would give us about 15 points of upside. Add that to the breakout point, might indicate a target up near $75 a share. So I think that there's still good upside left in this stock. And did I do that right? $72 a share. That's about right. So it looks like there's still good upside left in here. There's still a big short position as well. You can check that at NASDAQ.com. But there's a good short position. Those shorts are feeling the pain here. The stock just moved past this $62 level, and it's extended a little bit. So I think that maybe you could probably see it pull back towards 63 or so over the next couple days, maybe. Maybe by the end of the week you could purchase it down near that 63 level, put a stop under the $60 area. But I think this is probably the strongest candidate that there is of the group for continued new highs. Also, Sigma Designs, symbol SIGM. Here's a stock that's up at these all-time highs, and it's, it got very extended in here, but did pull back, and that was the pause that refreshed, consolidated underneath these prior highs at about $29 a share. And we can see now it looks like it's about ready to break out once again. So on this stock, I think that if you're in it, your stop probably goes near that 50-day moving average, is about $26 a share. As far as new purchases go, maybe a little bit closer to $29 a share. We've got this move past this recent resistance. We're looking at a 30-minute time frame about the last 3 weeks. But this resistance is about $28.50. Looks like it was tested as support. So I think that more aggressive traders probably put your stop just underneath that $28 level or so. Now, one stock that was an obvious candidate for continued new highs, or might seem like an obvious candidate, is Apple. The only and Apple looks like it's still in a good uptrend. It's back above that rising 50-day moving average. The only thing that kind of worries me here is this island reversal that we saw back in January. Those typically don't heal themselves quickly, so that's the only reason I wouldn't say that Apple is at the top of the list, in case you're wondering where that one is. QDEL is the name of this stock, this company. QDEL is the symbol, and I believe this is one of those little biotech or testing kit companies that has no revenues and that sort of thing. It has a history of being very volatile and then failing, so it looks like it's failing now. And basically, it's below its 200-day moving average. We've also got a declining 50-day moving average. The stock has been breaking down on heavy volume, followed by low volume rallies, just classic bear market action. And I think it's looking like the another leg lower here is probably pretty imminent in QDEL. BRL is Bar Pharmaceuticals, and Bar Pharmaceuticals is also below its 200-day moving average. It looks like it's probably going to retest this $45 level is what it looks like to me. The trend once established is more likely to continue than reverse, and is clearly in a downtrend. You might see bounces up near 49.50 or so, but I'd say the stock, declining 50-day moving average, guilty till proven innocent. I would stay away from this one and wouldn't be surprised at all to see it down about $45 a share. If you're an investor, maybe you look for support, evidence of support in that area, and once it starts turning higher from there, then maybe you want to consider it. But for now, the sidelines is the best, or maybe in a short position. Electronic Arts, ERTS, below its 200-day moving average. We've got a declining 50-day moving average as well, and it just looks like it keeps hammering away at support in this level. Really probably about 48 and a half, but it keeps hammering away at that. The more time support's tested, the more likely it is that it's going to fail, that source of demand is going to give up in that area, and I think you could see a quick test of the $42, $43 level in shares of ERTS, so I'd stay away from this one on the long side as well.